Today, the mortgage prisoner's debt trap escape hatch. Maybe. Hello again, it's Martin North from Digital Finance Analytics. Well, latest post covering finance and property news. Well, there was an interesting article in the AFR by Duncan Hughes talking about mortgage prisoners, those who have difficulty in refinancing because of pressure on either their incomes or equity. And he said that borrowers stuck in expensive loans are indeed finding a way out thanks to fierce competition among providers. Resimac Group, a leading non-bank lender, and Westpac are offering borrowers an early release from mortgage prison by slashing serviceability buffers, making it easier for borrowers to refinance, and triggering a fierce response from rivals. Mortgage brokers claim buyers are playing off competing lenders to refinance from loans that they would otherwise be trapped in due to not having adequate capital in their homes. Resimac and Westpac have eased the 3 percentage point servicing buffer set by Emptor. Resimac has lowered this to 2 percentage points, while Westpac is believed to have gone lower. Scott McWilliam, CEO of Resimac Group, says, following a comprehensive analysis of the interest rate outlook, we felt that a reduction in the serviceability assessment buffers was the right decision. We're confident that a 2 percentage point buffer still provides sufficient headroom should rates rise in the short term and give customers a greater opportunity of entering the property market, refinancing their loan, or using debt consolidation to assist with managing their commitments. Under the APRA stress tests, every new home loan applicant must show they can afford monthly repayments at 3 percentage points more than they are applying for, or the bank's preset floor rate, whichever is higher. A floor rate is the minimum rate a borrower will be charged. You're not trapped. We'll take you, lenders are telling borrowers, said Phoebe Blamey, a director of mortgage broker Clover Financial Solutions. Matt Turner, managing director of GSC Financial Solutions, adds, we are getting trapped borrowers out of mortgage jail by leveraging off lenders' new servicing policies. Chris Foster Ramsey, principal of Foster Ramsey Finance, said, if some lenders have moved to easing loan servicing, then others are likely to follow. If they're not relaxing lending criteria, then they are more amenable to discounts, and lenders are aggressively competing for new business. The Westpac changes can also apply to subsidiaries St George, Bank of Melbourne and Bank SA. Mortgage brokers say other lenders are easing conditions for borrowers with impeccable repayment histories and steady incomes despite the possibility of more rate rises. But they are moving more discreetly than lenders that have cut serviceability buffers by negotiating on a loan-by-loan basis, said Turner. Lenders typically stress test borrowers' finances to ensure that they can afford mortgage repayments if rates rise by 3 percentage points above the loan they're applying for. This has stopped some borrowers from being able to refinance to a cheaper loan, effectively locking them into their borrower. For example, according to National Australia Bank, 1 in 5 of its home loan customers are mortgage prisoners who cannot switch banks because higher interest rates prevent them from clearing serviceability buffers at a new lender. Hardest hit are likely to be first-time buyers who bought at the peak of the market with a small deposit. The number at NAB is 2 to 5 of those who borrowed between August 2019 and July last year, when rates were at their lowest. Borrowers seeking a cheaper loan will need to prove that they have an exemplary repayment record and can comfortably service the new loan, said brokers. Interest-only loans, debt consolidation and loans that require lenders' mortgage insurance typically will not qualify, and also excluded are applications that include a guarantor, which will bar most bank or mum and dad applicants. Borrowers applying for Westpac's streamlined refinance must not have fallen behind in repayments or reported hardship during the past 12 months, and the loan-to-value ratio must be below 80% and new loans must be principal and interest. The borrower will also be asked to declare that there are no foreseeable material or adverse changes to their ability to repay the loan. APRA, which sets lending standards, does not prevent banks from approving mortgages outside standard criteria even though 97% of loans meet the regulator's standards, and the rules do not apply to non-bank lenders. Critics of the APRA stress test argue that while the 3 percentage point buffer helps ensure new borrowers do not take out excessive debt, it also prevents others from being able to move to a cheaper lender. There are often households that borrowed at or near capacity when rates were at record lows, and the APRA stress test was 2.5%, said Sally Tyndall, Research Director at Rate City, which monitors lending rates. Since then, buffers have been raised to 3 percentage points, and the Reserve Bank of Australia increased the cash rate from 0.1% to 3.85%. Yet it is these very borrowers who are likely to need rate relief more than ever to help them stay afloat, said Tyndall. Bank chiefs, including NAB executive Ross McEwen, said the potential for higher interest rates to reduce mortgage competition could force regulators to reassess the level of serviceability buffers. And CBA, the nation's largest lender, says customers looking to refinance or for new lending will be assessed in line with the regulatory requirements, and they will not apply any differentiated buffer. And here's an example shown in the article with a potential home loan stress test rate under different serviceability buffers and potential savings from moving to a cheaper lender. For example, an owner-occupier borrower with a $1 million loan who reduces their loan by 0.85 percentage points to 5.59% would save around $19,000 in repayments over the next 2 years. Now, there's a few points to say here. As I have been saying for quite some time, many people are still not on the best available rates, and of course refinancing to those lower rates really does help in terms of the pain that's out there at the moment. Secondly, of course, lenders are being quite selective in terms of who they are helping, and certainly in my surveys there are still households who are not able to get out of the mortgage prison that they're in, particularly if their finances are also being hit, for example, by additional buy now, pay later commitments, or indeed other credit cards. And thirdly, this competitive environment is likely to morph in the weeks and months ahead. So this might be a small window of opportunity for some borrowers who are currently in the situation where their mortgages are unserviceable. So it is worth exploring, particularly with mortgage brokers or indeed with the online portals, to see what is available. But as Chris Bates and I discussed on Tuesday of last week, the truth is that a lot of these best deals are not publicly available, and you have to negotiate on an individual basis with your lender. So it's worth going in hard because, of course, it can make a significant difference in terms of cash flow. But the bottom line is this: we are not going to see mortgage rates come down anytime soon. If anything, they're going to go higher. And as income in real terms is still going backwards, more households are going to find it harder to service those mortgages. So anything that can be done to assist is probably good, except, of course, that what you're doing is kicking the can down the road. And one of the things that we're seeing quite often is actually extending the term of the loan to reduce the repayments. That means, of course, you pay a lot more interest over the life of the loan. So it might be a short-term fix, but it's certainly not a long-term fix. I have a feeling that a lot of the strategies offered by lenders at the moment are more in their own interests in terms of bolstering their profits and also reducing the default risk in their portfolios. And the knock-on effect is that some people benefit from that, but I also think, looking at my surveys, that there's a whole cadre of people who can't. So this mortgage prisoner issue is a big deal, and I suspect more will need to be done down the track to try and help people through. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.